So I'm here today on our Q2 market update with Jeff Pusich, Assistant Portfolio Manager with Waterway Wealth Management. Jeff, it's great to have you here today.
Yeah, thank you so much, Dan. Really honored to be here, and I'm excited to chat with you a little bit about the markets, what we've been seeing, what we're expecting.
Yep. So Q2 is wrapped up, and here we are. Stock market has been great. So everybody wants to know, how long is it going to last? Is it going to come to an end? So maybe give us a quick recap of where the stock side are, because that's what everybody wants to talk about today. But how did stocks do so far this year, or maybe this quarter?
Yeah, no, certainly. It's definitely an interesting time in the markets where, we're seeing a large cap growth, kind of more bull market right now. We have the S&P 500, which is up about 15% right now year to date. And so, being at the halfway point, that would project us out to 30% on the year. Some pretty large numbers there for the portfolios. And, just a very interesting time with all the buzz really that's around tech. So, tech year to date is leading the way along with communication services. Those two sectors really seem to be taking the lead here. And I think a lot of it has to be driven by, the buzz around AI and just a lot of the potential growth outlooks for these companies. But, interesting to note with the kind of leaders of the pack being close to 35% of the S&P 500. And it's, it's really kind of dwindled to a select few names that are leading us. So it's an interesting time. I think there's still really strong earnings growth that are driving these companies. So a little different than maybe the tech bubble that we saw earlier, and where that was, closer to 50% of the S&P 500 was tech. But still a lot of concentration. I kind of think of it as the Magnificent Four right now between, Microsoft and NVIDIA. They're kind of battling for that top spot, going back and forth. And then you got Apple and Amazon. So yeah, it's close to a quarter of the S&P 500 in those four names. And it's an interesting time. I think we can continue to see some strong earnings, though, just given how many contact points those four companies have in your day-to-day life. I really think about it from the standpoint of the end consumer. And how many days will you go where you're touching all four of those, if not at the exact same time? You go onto your laptop and order something from Amazon, and then you send a picture of it to your friend on your iPhone. I mean, just how many touch points and kind of the grasp they have on the end consumer. It really is a different environment than what we experienced during the tech bubble in the early 2000s. So, I think definitely a lot of optimism heading into the back of the year here.
Yeah. So you brought up the 99, 2000 correction with tech, and one of the things I think of is just the difference in earnings. If you go back to that period of time, you had large companies, but they were spending money and they were not generating earnings. But the earnings of those top four you mentioned have been fantastic and actually continue to outpace. So what do you think happens, in the second half of the year? Are they still going to dominate, or do you see the market broadening out? What are your thoughts?
Yeah, so, I wish I had a crystal ball to be able to tell you guys the exact answer. History would indicate that you're going to see a market correction every 1.2 years. And so when I'm talking about a correction, it's a 10% pullback in the equity markets. Little different than a bear market, which would be 20%, or an actual recession where we're seeing GDP have two negative declining quarters. So, with that being said, and given where we're at, I think we can anticipate some volatility. Now, where does that leave us with the actual fundamentals of these companies? I think the growth outlooks, like I said, are still tremendous. We're seeing strong earnings. Honestly, just given the backdrop of the economy, for me personally, I think it's hard to see these companies faltering a lot. Now, with that said, some of the other macro pressures. We have the election coming up. I think there will be some underlying volatility in the back half of the year, certainly probably into 2025.
Yep.
And so it'll be interesting. We'll see kind of how the Fed reacts, how inflation reacts. For me personally, the backdrop is just so different than from when I really first started my investing career about 10 years ago.
Yep.
So just to see the change and everything that's happening, I think it's a new environment, and people are every day trying to digest data points. And, the markets are very efficient, but when you're kind of in this unknown territory,
Yep.
It's hard to predict. But I would see probably some broadening across, asset classes and sectors in the back half.
Yep. So thinking about Q2 specifically, one of the surprising things is how much has changed with the 10-year Treasury bill, because it was, much higher as we came into Q2, and now we're at about 420 on the 10-year. So I think we've always been in the camp that higher for longer will likely happen. And here we are, looking back at Q2 and thinking, it made a big move. I guess it was about April. Mm-hmm. You saw a big change in rates, and then now you start to see them come back down. So what happened during maybe the second quarter with the 10-year Treasury?
Yeah, so I think, it's interesting, right? Because going back to, the pandemic and a little bit post-pandemic, we had relatively no yield. So now, it's interesting when we're kind of examining, 50 basis point shifts. But to your point, it's still powerful in that short time period. And I think probably, just given how inflation has remained pretty sticky, PMI still relatively high. Yep. I think unemployment, though, has, remained relatively low, or around that 4%. So I think a lot of these things are all, economic indicators that the Fed is looking at. And we just really saw that shift from, expecting a lot of rate cuts, probably a little quicker. And like you said, I think we've been in the higher for longer camp, not necessarily thinking there's going to be, I think it was 6 rate cuts. Yep. When we went around Jan 1 of this year for the outlook. And now that's really moved what I'm seeing on Bloomberg, closer to 1 cut for this year, and maybe an additional cut at the beginning of 2025. So I think a lot of that, just kind of the sentiment around what the Fed's going to be doing, has played into, what you mentioned as far as the change we've seen in the 10-year.
Yeah. And then the other piece during the quarter is we've seen inflation is finally starting to kind of subside a little bit. We had 1 month that was bad, but inflation has dropped quite a bit too, right? So
yeah, PCE, we've seen that slowing, and I think that's a good, economic data point that the Fed is also looking at. I think, back to my comment earlier, when I say it's been sticky, just stickier than we really thought it would. Right. I think everyone was thinking it would cool down a lot faster. And but to your point, it is cooling. There are, which, we're seeing unemployment tick up very slightly, right? So I think there's some data points that are heading in the right direction. Yep. I think everyone with the timing was just maybe a little bit off.
Yeah. And with earnings so strong, it's kind of given the Fed the ability to pause on making any adjustments. If the economy was slowing very quickly, I think they would have to start cutting. But so far, unemployment's been hanging in there. GDP looks to be pretty solid here in Q2 when we get that number. So so far so good on a soft landing.
I would agree with that. Yeah, one thing I really enjoy looking at is some of the real estate statistics and the mortgage rates, and that's another area that I think is sneakily strong right now. Mm-hmm. I think that we probably would have anticipated to see a little more decline in that area, especially when it comes to some of the inflation numbers around that sector, and it's remained pretty stable. So, yeah, to your point, I think it's one of those environments where, hey, if it's not broke, don't fix it, and we continue to march on.
Yeah. So talk about let's look at the bond market for a second, because we saw yields have come back up with the Fed raising rates, so we get a nice yield on the bond piece. But we actually saw bond values go down this year. How did they perform for Q2?
Yeah, no. So, I mean, when you look at the ag for the second quarter, it was relatively flat.
Mm-hmm.
And I think what, a lot of things that we're seeing out there are, on the treasury side, we're definitely having a little bit higher yield just with kind of that government backed protection and kind of some of the more cash like securities.
Mm-hmm.
And so overall, with the bond market, it's, definitely looking at some of the credit quality and different pieces within there. The inverse relationship with the bond yield and price, overall, I think has been a bit of a lag on performance. But something that I think we're still optimistic on, just given kind of, the place in the portfolio and how it leads into diversification for our clients. So, yeah, it's been, I'd say, kind of a tougher environment when you're seeing, the short end of the curve, with the inverted, it's essentially inverted curve right now. And that's another thing for me, which was like, wow, I've never experienced something like this. So it is interesting, but I do think, there's hot spots along there, especially, some of the like 12 to 14 year duration. I think we're able to see where that yield kind of picks back up. And so kind of having that barbelled approach with bonds as far as some exposure on the short end, as well as kind of more intermediate to the long end. I think that's kind of where you're covered at. So while the ag hasn't necessarily performed on this past quarter or even year to date, I still think there's a lot of value there.
Mm-hmm. Yeah. It's very different to have a yield of, on a money market of 5% or bonds yielding 5.5 or 6%, but now they're out there. So in the past, maybe 10 years, we haven't seen much coming from the bond piece. And so finally now you can actually get paid to own some bonds.
Yep. No, that's exactly right. It's been interesting to observe that and just kind of see the shift in flows that are going into those spaces, as well as alternatives. I think that was another space that during the pandemic people were looking for yield, and there was just kind of an inflow, and now we're seeing some of the traditional fixed income and the muni bonds in particular really pick back up. And so I think that tax equivalent yield is really something that investors are seeing valuable more and more.
Yeah, I think that will play out well as we get into 25 and potential, tax code changes. If the current code goes back to the old code in 26, those munis will be very attractive and people will enjoy that. Yep. So, well, let's pivot. Let's go forward looking. We talked a little bit about Q2, but as we look at maybe the second half of the year, one of the big things is going to be the Fed, obviously. I think the bond futures are pricing in one cut.
Yep.
So what is the outlook right now for interest rates between maybe now and the end of the year?
Yeah, it's definitely, we're thinking rates are going to come down. I don't think there's a lot of people on the street that are projecting another cut. Now, if there were to be a black swan event or some, unknown market event that were to take place, that could always change. But yeah, I'd say, the trajectory is still lower. And yeah, we're looking at, like I said, probably 1 to 2 cuts, 25, 50 basis points for this year, and then another cut, potentially more in the back half. I think after the first cut and how the reaction is from the markets as well as the economy, we're going to see kind of what the plan from there is. But I think for now it's really one step at a time. And like I mentioned earlier, I think the bond piece still really has a home with yields just being higher than they were, when you're kind of starting from nothing and then coming to where you're at. I think there's going to be a home for bonds in the portfolio going forward. And, I think especially as, maybe those rates do come down, then we'll see some of the, reward from some of the corporate bonds, definitely treasuries still. And then, like you mentioned, the muni bonds and for the taxable accounts, I think that's going to be a key factor. And we'll see some attractive yields in the back half.
Yeah. Yeah. I like the space of munis. I just think that's going to be a nice one. So if you get a rate cut, 1 or 2, it's going to be a nice tailwind for stocks and for bonds in the second half of the year. So I got to ask you the most questions we get around elections. So, November is going to come quickly. We already have started to see the noise. What are your thoughts on the election and how a portfolio should be positioned?
Yeah, no, great question. Something I'm hearing a lot about. One thing I like to point out is that despite it, or in addition to it being an election year for our country, it's also an election year for many other countries across the world. So I think just the geopolitical climate, given that, is a little bit more delicate than it could be. But as it pertains to the U.S. markets and the election, there's really no historical data that would indicate there's really any correlation to market returns. And that's really, when you're looking at it more as a long-term investment in the markets. So as far as, our thoughts at Waterway, we really truly don't believe that the, election is going to have a long-term impact on, your portfolio returns. But with that being said, there's definitely going to be, heightened volatility leading up to that point. As you mentioned, I think we're already seeing it. There's so many things in the news, different headlines, and it creates what the market hates, which is uncertainty.
Yep.
So until we really understand who's going to be in that seat, we're going to have volatility. But going back to our conversation earlier on why the market's been doing so well, it's these large cap tech companies that are well established and have strong earnings. So, in our mindset, if we do see a market pullback, given some, things that may or may not happen with the election, we may see that as a great opportunity. The fundamentals shouldn't change. Now, there will be specific sectors that are impacted with the tax changes and tariffs. So, yes, we're not neglecting that it will probably have an impact. And even to the end consumer, if tax brackets change, that's massive.
Yep.
So we realize that there's changes that are likely to come from this. But as far as it pertains to specific market returns, I think our philosophy is stay the course.
Yep.
And if you have a long enough investment horizon, you'll be able to withstand kind of the market turmoil we might see during the election.
Yeah. Well, and that's some of what we've been just doing recently this last month, right? So making some adjustments in portfolios, taking advantage of some of the big runs, and then building a little bit of dry powder in case we get that volatility.
Yeah.
So it reminds me of last fall. We had market correction August, September, October. Market went down 10%. Like you mentioned, we typically get 10% move a year. And, if that happens again, we're actually going to lean into it and take advantage of it. So when you look into the fall, too, I would say, what do you think happens? The Fed, obviously, I would say they don't want to be political. But do you think the timing of their cut would come September, October, or do you think they push it to December so they don't try to look like they're interfering with elections?
Yeah, that's a great question, something I've been thinking about. I think it will probably come after the election if I had to take a stab at that one, just because I do think there's going to be volatility and so many things that they're trying to work out. But, time will tell. It could be something where, the cut does happen pre-election and they're trying to kind of get it out of the way. So it'll be interesting. I personally think it'll happen probably post, but, we'll see.
Yeah. So I've got to ask you a little bit about Core Plus. So you've been involved in the last year in our individual stock sleeve. So it's about 30 names. So maybe if you just tell us a little bit about it and how your experience prior to Waterway, how that fits in with Core Plus stock sleeve.
Yeah, no, certainly. So I'll start with my kind of background and, I think what really made Waterway such a great match for myself, as well as the team, of course. I'd say, I started off really on an equity research path. And so by that, I was really, performing due diligence on publicly traded companies, particularly in the small cap space was how I had my entry into the business. And so from there, I started on an investment bank where I was covering financials. It was basically 25 regional banks based on the West Coast. And, I had to know them like the back of my hand. we would speak to, the actual representatives of those companies as well as institutional investors, similar to Waterway. There was a lot of RIAs that were interested in our research. And so it was one of the learning and I'd say kind of more like baptism by fire. And
cut your teeth.
Cut your teeth. I was working just directly under an analyst, and we would have for the banks when they would report their quarterly earnings, it would come in about a 2-week period. So we would write 25 research reports in a 2-week period. I mean, I don't know how often I saw my bed, but it was
updating your models.
Yeah,
right. All the models get refreshed.
Going through the 10 Qs, updating the models, and then really being able to synthesize that quickly and efficiently. So it would be to where I'm updating a model while my analyst was writing the research report. I'd go back through, or I'd take a stab at it. I mean, if we had a day where there was 6 companies reported, I'd have probably 2 or 3 working at once, and he'd have 2 or 3, and then we'd switch and kind of, do due diligence checks. And it was very imperative that the numbers were accurately inputted. So that kind of broke me into the industry. Did that for about 2 years. It was on the West Coast. So, early hours, waking up at 4 a.m. Definitely an interesting time in my life where I was really focused on work. And I kind of knew that wasn't always going to be for me. It was kind of more just kind of get my foot in the door and figure out, a lot of the fundamentals that maybe I hadn't learned in school. And so it was a great opportunity. From there, I actually left and went to the buy side where I was working for an RIA in Portland, Oregon. And at the time, I kind of joined in a similar position to what I'm here now at Waterway. It was kind of wearing a lot of hats, doing some due diligence on mutual funds and fund managers, as well as doing some back office trade settlement type related activities, working with the custodian, and then also some equity trading. So I got some great exposure to different facets of the business, and I think that kind of helped. From there, I actually went into an equity trading position.
Nice.
And so that was a unique experience. They kind of say it's a lost art in the world of finance right now, and there's not a lot of young aspiring traders.
Yes.
So, most of my counterparts were seasoned vets, and I did get to learned a lot about technology and the systems behind trading and settlement and all the different ins and outs. So I think just from like a technical standpoint, very helpful, definitely different than kind of the research focus I had.
Yep.
But really kind of brings me to today where I was looking to get back into that kind of CFA research path.
Yep.
And so it was really, like I said, just kind of a match made in heaven when I found Waterway and got introduced to Jack. He's been such a pleasure to work with. He's, just a wealth of knowledge, and yourself, obviously. So I think it kind of brings us full circle to Core Plus, as well as the trading. I think those were the two like really main direct experiences I had. And after meeting with y'all, it was like, hey, this is what we need. I was like, perfect. Well, that's my kind of two experiences in the field. So, you want
to tell them a little bit about what Core Plus is? So for those who don't know.
No, appreciate that. Core Plus really is our individual stock sleeve. We own around 25 individual names, and we're benchmarked to the Russell 1000 value. So when you're thinking of kind of indices or benchmarks to track our performance, it's not going to align with the S&P 500 or the NASDAQ. It's a different benchmark. But we recently had our 3-year anniversary, which established, a track record on that specific portfolio for 3 years. And we've had some nice performance. There's definitely, like I mentioned, a value tilt. We focus on really high quality companies with strong paying dividends. But a key aspect to that portfolio is the individual holdings, and that gives us the opportunity to tax loss harvest for some of our high net worth clients. And we're seeing just a tremendous amount of value that we can add to the clients, and definitely when they're, approaching a larger market value, being able to go in there and harvest those individual names so they can reap that reward, and on the tax side is big. But yeah, we've really refined the process of just our kind of research between the sectors for Jack and myself, and just really being consistent. So something I'm really excited about. Definitely, as I joined, we kind of had to divide and conquer and kind of figure out our calendar and just responsibilities between the sectors and the coverage. But something that I really enjoy. It's a passion of mine. So I'm really looking forward to continuing down that path.
Yep, that's the fun stuff.
Yeah, what I would call the fun stuff. And then, something else worth to note, I think what we're going to be looking at kind of as a complement to the Core Plus portfolio is a more S&P focused kind of individual security portfolio. And it will kind of track more like a benchmark than anything. We'll be really recalculating and rebalancing based on the S&P 500. But it's something that I think is on the horizon as far as being able to have an opportunity with some tax losses for individual names.
Yeah, and that's nice when somebody has large after-tax money, be able to save some tax dollars. You create a little tax alpha for them.
Yeah,
right? At the end of the day.
Definitely.
Yeah, so that's the fun stuff. So, what else is on your mind when you think about the portfolio going forward here as we look into maybe into 24, but maybe even look further beyond 25? What do you see, portfolio? Because we definitely made some adjustments in the portfolio in end of Q2, trimming some of the things that have run. But what would you see going forward? Other changes that might happen in the portfolio?
Yeah, I think that was a big one, obviously, that we just accomplished, which was, like you said, kind of taking some profit off the table from some of the larger cap and growth equity funds, and then being able to kind of redeploy that in either into fixed income where we were under allocated, or having some kind of dry powder on the sidelines to be able to take advantage of some volatility.
Yep.
I do think there's going to be some broadening. And so I think having exposure, as far as kind of more that core and domestic kind of allocations, I think are important. So, that would be really like your S&P 500 ETF. That would be, international still, where we're kind of more on the core side. And then also small cap. I think there's going to be kind of some reversals where you're going to see that broadening out. And so, yeah, I think overall equities still have a real positive outlook into 2025. Like I said, I think there will be volatility, but it's not to the point where, you're wanting to sell. It's stay invested, stay the course, focus on that investment horizon. But yeah, I think that kind of just core allocation is going to be important as far as, when it comes to style between value and growth. We may see a rotation to value, but it's going to be hard to determine, especially with how the growth has ran. Yeah. So I think kind of being balanced and focusing on high quality is going to be really important. And then, like you said, I think we've taken measures to really hedge ourselves in a way and be ready to take advantage of those opportunities. Yeah,
we know there's volatility coming. It's just inevitable with the uncertainty of elections, uncertainty of the Fed. I think it's going to give us some nice opportunities this fall.
Yeah, no, I think where we're situated right now, there's going to be, some good rewards to be reaped, especially, outside of the large cap growth market that we've been in. And I think that's where the diversification is so important, because you'll see just the different asset classes, how they shift over time. And, right now you got U.S. large cap just
running the
leading
show.
The charge. But you look back in 2022 and that wasn't necessarily the case, right? So I think that that just goes back into being able to make sure you're covering the different asset classes and just see what's happening in the future here.
Yeah, it's going to be an interesting second half.
Yep.
We'll know a lot more, probably not on the Q3 update, but the Q4 update will be very telling. So a lot on the horizon the next 6 months.
Agreed.
But thank you for your time. Really appreciate it. Jeff Pusich, Associate Manager, Portfolio Manager at Waterway Wealth. That's it for today. Thank you.
Yeah, thank you so much, Dan. Really appreciate it.